Hey, welcome to the show, Total Financial Solutions, Safer Money Hour. I'm Arif Halaby along with Jeff Gerard and Brian Clark. We're going to talk with you a little bit about putting together your financial life, like creating something that makes a difference for some of you in your portfolio, in your overall planning, and what is it going to take for you to retire and diversify your assets, all those fancy words. We're going to learn a little bit about a particular asset class that some of you may know or may be familiar with, but for a lot of people it's misunderstood. So let's welcome Brian Clark. Brian, you're from Reliant Life Shares. Tell me about Reliant and, of course, Life Shares, and what does all that mean?
Hey, Irv, thank you very much. I appreciate that. I work as the Director of Business Development for a firm called Reliant Life Shares, based out of Sherman Oaks, California. And what we do is something unique in terms of bringing what we call institutional profitability to the individual investor. What we really center around is an investment known as Fractional Life Settlements. And most people have never heard of this. A lot of financial advisors aren't aware of it even. And that's mainly because historically this asset class or this investment has been utilized by the institutional investors, the big players, the Warren Buffetts of the world, the Blackstones, Deutsche Bank, Credit Suisse. A lot of these large firms have employed this as a strategy to help augment the other risks they may have when running their money. But the individual investor is really not aware of it. But we try and bring this solution down so that they have access to it. We educate and help them employ it. And we find it rewarding for a lot of investors.
Well, Brian, what I've learned in the financial industry is that when a financial product is created and named, that every part of the name has a meaning. So when we talk about fractional life shares or life settlement, tell us a little bit about that. So are we buying a life insurance policy, or are we buying a piece of something? How are we taking part and participating in something like that?
Well, it's pretty unique. What we do at the end of the day is we are buying life insurance policies from seniors who no longer need them, want them, or can afford them. Then we open up investment into those policies to individual investors on a fractional basis. So the term life settlement is really just industry code for the sale of an unwanted, unaffordable, or unneeded life insurance policy. When you sell that policy, it's termed that you're settling it. So it's a life insurance policy, settlement, and then because most investors don't have enough money to step up and buy a piece of, $1 million policy, I mean they don't have enough money to buy the whole policy, we let them buy pieces of the policies. And that way they can buy not just one, but hopefully a piece of many policies to further add diversification. And that's really what we're getting to here, is allowing investors to diversify.
So back in the day when mutual funds were created, mutual fund is owning a piece of a large amount of a company. In other words, it used to be if you said, I'm going to take and buy put all of my money in one particular company. Well, that would be great. If the company does well, you make money. If the company doesn't, you don't make money. So when mutual funds were created in 1924, it took the same amount of money, spread it out, so you owned a little bit of 10, 20, 500 different companies. And by spreading out that risk, the goal was to say if one goes up, one goes down, you can kind of diversify. Today, that's not quite the case, but in practice and theory, it's slightly different, but it works. So what does that do when it comes to the life settlement process? Well, it's very clear, I think. Instead of owning a piece of a particular life insurance policy of somebody who might live a very long time, who when they pass away, this life insurance policy pays out the death benefit, the life insurance amount, to the people that own the policy, and in fact, whom the beneficiaries are. And in this case, the beneficiaries are your investors.
Absolutely. And I think at this point in the conversation, I want to make something very clear because a lot of the listeners out there may start thinking, wait a minute, this sounds kind of different. I'm profiting off of other people's life insurance policies. Well, didn't they need it? Didn't they want it? And the answer is no. When we take a quick step back, if we could, and look at the two main kinds of life insurance there are in the world, there's term insurance and there's what's known as permanent insurance. A lot of people think, well, if I buy a permanent insurance policy, I'm going to have that until the day I pass away and it pays out the death benefit. But that doesn't always work out that way. A lot of people intend that when they buy it, but they get to a point in life, maybe they bought it when they were 70 years old and now they're 80, they're in poorer health, they didn't sock away enough money into the policy, and their option, if they can't afford it or don't need it or don't want it anymore, is to either let it lapse, okay, in which case they paid into it for many years and then now have nothing. They could cash it in if there's a cash value built up in the policy, which these permanent policies, like universal life policies is what we're talking about, they have an element of cash value. But if I've got $1 million death benefit and I basically have $50,000 of cash value, if I get $50,000, that's an option.
Right. So they're going to say, I'm going to give up $1 million to get that savings portion, if you will, that is $50,000. But you guys come along and you offer them, for the sake of argument, $200,000.
Exactly. And that's why
they're much happier.
Absolutely. That's why this really can be a win-win scenario, because at the end of the day, if a person is about to cash it in for 50, and by selling it, if they learn they can get $200,000. That senior is greatly benefited, maybe to afford a better quality of care, do what they want to do with their remaining years, et cetera. So 3 or 4 times as much money is certainly not unheard of in this business. So when our investors go to invest in these policies, it's important that they remember that they're actually, by being a part of a secondary market of life insurance, they're actually benefiting the seniors that were about to either let the policy go, throw it in the trash, or cash it in for a much lesser amount. And just one final point on this, there was a study done in the early 2000s by the Wharton Business School, and they looked at nearly 1,600 policies, and they found that if you cashed them all in, you'd get about $93 million. And yet if you sold them, you'd get over $300 million. It was about a 360% increase.
Wow.
And so that's some academic proof to what we're talking about.
And so that is an option for people who say, listen, I bought this insurance policy at one point, and I did so because the purpose of it was a good example. Warren Buffett, when he built his estate plan, he built it as if he would pass away first, but his wife died kind of rather suddenly. And I remember seeing, because obviously this is our business, going through a process, seeing him go through a process of retooling his entire estate. Instead of benefiting his wife, who has predeceased him, he in fact was benefiting charities and nonprofits, etc. But he changed everything about it because his wife died before him. And sometimes that happens. You're building a life insurance policy for somebody else's benefit, and they may die before you. And so you don't need it anymore, or the reason doesn't exist.
Absolutely. There could be a divorce. Maybe a business doesn't exist anymore. Maybe whoever you bought it for predeceased you. Maybe you just changed your mind. Maybe you need more money now. That's more important to you than leaving it. And so that's really what I would call the front side of this business, is how these policies come to be able to be invested in. And instead of leaving it up to the big players, the institutions, Reliant Life Shares exists to help the average investor, if they're financially qualified, to be able to participate in this marketplace if it's a good fit for them.
Yeah, so you're the opposite side of that formula.
Well, and I think it's important to bring to light is we're benefiting someone while they're living. And when you buy a life insurance policy, I know when I bought mine, I was never going to see the benefit of it. I would just have peace of mind that somebody else would have that when I'm no longer here. But if my needs change, and I think it's important to highlight this, if my needs change, and this is where I think a lot of the opportunity comes in, having the ability to sell that on that secondary market, that can be a life changer. And Brian, I've heard you share a story about someone's life who was changed by that, who was otherwise destitute. They had a policy that was illiquid. They had to die so that somebody else could benefit from it. Yet while they were living, and they had just come off of a pretty big financial loss, and they were able to cash in a policy above the cash value and change their whole financial life.
Absolutely. There was an older couple, and one of the members of our firm had met them after they had already literally thrown their policy in the trash. And it was only after that was recently they had tossed it, that they found out that, guess what, it hadn't fully lapsed yet. It was still in force. They went ahead and helped them make a premium payment, confirmed that the policy was still in force, and ultimately were able to hand this couple, who really needed it in their older years, a check for nearly $500,000, and from something they had literally thrown into the trash.
Yeah, so, from zero value to nearly $500,000 is a life-changing event for anybody. And when we are investing, when we are buying into these life shares, we're seeing some trade-offs, right? We're seeing, if I'm a normal beneficiary of a life insurance policy for my husband, wife, spouse of any sort, I can receive those those funds tax-free. It doesn't. My kids don't have to pay tax on my life insurance policy. They will on my IRA or my 401k, but not on the life insurance policy. So to kind of get that out of the way here, that is not the way it works, because when it's settled and the beneficiary is now a trust, a third party, if you will, and we'll get into a little bit of those details, I am now an investor. So it's a regular security
Correct.
investment?
It's a security here in California,
Okay.
and the important thing I think for your listeners to know is that it's regulated through the passage of a Senate bill here. It's called Senate Bill 1837 that regulates this investment as a security. And it says everything that we must do to offer this security to qualified investors who can invest in it. In other words, how do they qualify? And at the end of the day, it's a security, so it's like an investment. But instead of having stock market risk or bond risk or real estate risk, and let's face it, right now, we're hitting all-time highs in the stock market again. Everybody's feeling a lot more comfortable because real estate's come back a long way. This probably is not a bad time to take some gains off the table, right? We've seen since Trump got elected a 10 to 15% run up, in the stock market, and is that going to last forever? I don't think, we all know trees don't grow to the sky, right? It's probably not going to last forever. And so now is the time to maybe slide a little bit of risk off the table, lock in those gains. The game, as we know, is buy low, sell high, and maybe add some true diversification with something that's going to act independently or separately from those other investments you may hold, those stock market investments, those real estate investments, et cetera. This is a great example of that, because when a portfolio of people that have insurance policies, when each one of them matures, what does that have to do with the stock market or
that
the bond market? It has nothing to do with
non-correlated.
Yeah, exactly.
I think in 2008, it was the first time that we as a nation, at least in a long time, I think it's happened in the past, but the first time to this extent, where we saw both real estate collapse and the stock market. And that was a pretty scary event. I think that was evidence to the fact that today people were saying back then we were just 2 weeks away from losing the stock market as we know it, and our U.S. economy as we know it. I think that is I think that's a scary place to be. So this is outside of that. So for a portion of or a piece of some of their account, this is what you guys are saying could actually be the case. And that is a non-correlated asset, meaning it doesn't go up and down the same time as everything else that most people have as a part of their portfolio. Now, we always talk about safer money. When we say safer money, we mean safer from the market, safer from the risk. So what are my risks with buying into a LifeShares account?
Absolutely. That's a great question. There are a few, but the primary one is going to be longevity risk, right? Because when you invest into a life insurance policy, premiums must be paid in order to keep that policy in force so that you do get to enjoy the death benefit. So it's really longevity risk. But again, acting independently from all the other risks. In other words, if you have $1 million invested in real estate and stocks, are you better off adding a little more real estate and a little more stocks, or would a 10% slice in something that's going to behave differently that, by the way, has double-digit return potential, and it's really longevity risk. It's an illiquid investment. We want to make sure we make that clear as well. You're going to be in the policies until they mature, but if you've got some money that's earmarked for later in retirement, and going back to your question about taxes and tax-free, you can invest with Roth IRA assets, and in that case, the proceeds would be tax-free to you. You can invest with IRA assets, in which case you can defer those taxes, and of course you can invest with cash as well. But at the end of the day, just to have a slice of your portfolio disconnected, unplugged from all the other risks that the rest of your portfolio is seeing, that can act as a shock absorber, or as the industry calls it, a hedge to your other investments. And if people have ever wondered why the big institutions have done better at investing than the average investor, it's not only what they do when they do it, but it's the strategies they employ, this being one of them.
Yeah, and this can help reduce some of that cross risk. One of the focuses that we've always had is by not putting all of your eggs in one basket. It's a real simple theory, and today with most of us not being in farming or ranching of any sort, when that means is very simple. When you were walking with everything in one basket and your eggs and you fall over, you break everything. And it means that you may have to make multiple trips. You may have to diversify. You may have to use different things, but it's because if one event happens, we don't want everything collapsing. If one bad day or a war or the stock market collapse, or China and Russia decide to do something, or North Korea, who's of course extremely predictable, right? Another Brexit. France just really dodged a bullet, if you will, by its potential leaving of the EU. Do you think that's gone forever, or do you think that may be a future thing that's going to be needing to be addressed again and again? These kinds of things can and do impact your portfolio in sometimes a good or a bad way. We're going to take a break, and when we continue, we're going to continue with Brian Clark from Reliant Life Shares, Fractional Life Insurance Policy Ownership. Is that the right way to say it?
Yeah, fractional life settlement investing, absolutely.
All right, we'll continue just a minute. I'm Arif Halaby. That's Jeff Gerard with special guest Brian Clark from Reliant Life Shares on your place for news, talk, and information. This is AM 1220 KHTS.